Hey everybody, John Skiba here from the Arizona Consumer Law Group. I'm also founder of the Consumer Warrior Project. And on today's video, I want to talk about some of the tax consequences you can have when you settle debts. Now, let's say you owe a bunch of credit card debt. You're looking at your different options as far as how you can actually deal with these debts and get them off of your back. You may be looking at things like bankruptcy. You may be looking at debt settlement, where you're reaching out and trying to negotiate an amount less than what it is that they're actually seeking payment on. So when it comes to debt settlement itself, it's something I want people to be aware of, is that there can be tax consequences if they agree to take less than what's actually owed on the debt. And this is something that often the debt collectors don't bring up in the negotiations. So I think it's important that you understand that there can be consequences, tax consequences, for settling a debt for less than the amount that's actually owed. Let me show you how this works. If they agree to reduce the balance, they agree to settle the account for anything over $600, the creditor or debt collector is required to send you a 1099-C, which is a tax form you get at the end of the year, for the amount that they've forgiven over $600. Then you're required to provide that in your tax return as income. It's as if they essentially gave you that money, and you have to treat it as income, and thus you're going to be taxed on it. So this could, depending on how much you're settling the debt for, this could be really not a big deal, if this is just a couple $100 type thing, or it could be something significant. I've seen clients that come in, they have $100,000 in credit card debt, they settle all of it for $50,000, but then they're going to get a $50,000 1099-C at the end of the year. That could really, impact things as far as the amount of taxes that need to be paid at the end of the year. So it's something to be aware of, that there may be some tax liability. I highly recommend if you've done a lot of debt settlement in a particular year, when you go to file taxes that following year, that you use a CPA or an accountant, a tax professional, to be able to help guide you through that, because there are some exceptions to this. And one of the main exceptions is if you are insolvent at the time that you entered into this agreement. Essentially, if your debts outweigh your assets. And there are a few other things that the CPAs and accountants can do to help you to avoid having to pay taxes on those particular accounts. So just something to be aware of if you're in debt settlement. It's often a good way to resolve your debts. One little asterisk to this: if you do file bankruptcy, the same is not true in bankruptcy. If a debt is discharged through the bankruptcy process, the IRS makes a distinction between that and a debt that was forgiven through debt settlement. So if you file bankruptcy, there's no tax consequences there. So that'll do it for today's video. If you want to learn more about solving debt problems, bankruptcy, debt collection lawsuits, head on over to our website at consumerwarrior.com. We have hundreds of articles, videos, audio podcasts, a lot of free resources to be able to help you as you continue on your journey to get out of debt. Thanks for watching today.